Good morning and welcome back to Margin. This morning I'm going to talk about personal loans and two types of personal loans that I do recommend. So this is broken down into a two-part series and this is part one. So let's jump right into it. Being that this month's theme is credit and unsecured debt, I wanted to jump into the four types of common unsecured loans that are available to you today. Now, some of these are recommended and some are definitely not, but I want to go through the pros and cons of each and what products are out there that are readily available for you. So as a reminder, unsecured debt has no underlying asset. So typically they have and carry a much higher percentage rate in order to have that debt because they don't have a vehicle or a house that is securing that loan. So the first common unsecured loan comes down to a signature loan, also called a personal loan. So these personal loans have a fixed term to them, and when you apply for that loan, you are typically required to have a good payment history and excellent credit. So they're in good faith giving you a loan that they will hand you a check for. You'll get let's say a $6,500 check to buy a set of braces or to build a wall in your backyard. And you will then pay on a schedule on a monthly basis, the principal and interest over a period of time that's fixed in order to pay that off. Now with this, you have a fixed payment, you have a fixed term, and you have a fixed interest rate. That rate is typically about 10% depending on your credit score. Now the drawback of this is the fact that when you are getting that fixed term, when you are setting up that loan, when you pay down that loan over a period of time, you can't take out the difference between what you owe on that loan and the original loan that was awarded, the amount that was awarded originally. And so with that, oftentimes you're stuck with that loan as it is. You can't necessarily use that remaining balance that may be available through a different avenue. So with that, also the drawback with these loans are that they do have a high interest rate. Now they don't necessarily have a high enough interest rate for you to justify putting that item like those braces on a credit card because this is still a cheaper option. But at the end of the day, you have to look at, okay, does this personal loan make sense for my finances? And oftentimes people look at these personal loans as, okay, well, at least it's not revolving. At least it's a fixed loan that I'm paying a minimum payment or a payment on a monthly basis and paying it off over a given period of time. And that revolving nature of it can be a pro and a con in the sense that you don't have a fixed period of time with a credit card, for example, that you have to pay it off. Whereas this, you're going to have that payment on a monthly basis that's based on the loan balance, based on the original loan balance that you took out, and you'll pay that interest and principal on a monthly basis. Now, these personal loans do not have an underlying asset, hence unsecured. But with that means that you don't actually have your car or your home attached to them. So it makes it more risky for the institution that's actually originating the loan. But for you, at least it's not attached to something that physically can be taken away from you. Now with that, the other aspect to look at is these loans are typically $1,000 to $50,000. They are for specific projects or for specific needs, and sometimes those needs won't match this loan type, and it won't make sense for you to utilize this loan type for whatever you're trying to accomplish. So the second common unsecured loan type is a line of credit, or a PLOC, which stands for personal line of credit. So these lines of credit that you can have extended to you if you do have excellent credit and a good payment history. They typically are charged about 12%. So they sit in between the cost of a fixed personal loan, and a credit card. So with these, they have a variable rate, so that 12% can go up or down accordingly. And they also have a fixed term based on your utilization. So if you are not utilizing your line of credit, you can, not pay that interest rate. So the nice part about these lines of credit is the fact that you are approved up to a certain amount, but you don't have to take that amount. And you are only paying your payment on a monthly basis based on your utilization. So you'll pay principal and interest, much like your personal loan, but you will have it paid out on a fluctuating basis based on your utilization. So if you do decide to utilize a line of credit, you will probably have to renew it on an annual basis. So they may look at your financial standing at each point, each year along the process. So I've had a personal line of credit for about 9 years now. Now, I've used it on occasion for various purposes, and it is one of those things that sits in the background, and for many Americans sits in the background for an option, as an option. And as it sits in the background, I don't pay anything on it, if there's no balance, but it gives you an opportunity to have maybe a overdraft protection on your bank account or some other purpose to give you an option. Now, with a personal line of credit, of course, as I mentioned, it has a fluctuating rate, fluctuating term, and you have to actually have it renew based on you qualifying on an annual basis. Now, with that, that's why it may not be the right product for many people, especially being that that loan, that line of credit can be called at any point, and you would have to pay off the balance and look for another option. Whereas a personal loan, they will not look at your credit worthiness after you get qualified for that loan in the first place. So that can pose a risk, especially if you're in uncertain times, within the economy. And so many people about 12 years ago now that went through the Great Recession experienced this. They experienced their line of credit, and whether it had an underlying asset attached to it, like a HELOC, for example, for a home equity line of credit, or a line of credit, which is a personal loan, either side of the equation, people were experiencing their banking institutions, closing down their lines of credit and calling their loans. And it actually caused quite a few issues. It caused issues with people not being able to pour those funds into that institution to pay off that remaining balance of that line of credit. And so that's something to be mindful of, to make sure that you're using it responsibly, knowing that it is a revolving line of credit. So the last component of the personal line of credit that I want to bring up comes down to the fact that it's revolving. Much like a credit card, you want to be careful about your utilization. You want to be careful to keep it below that 30% mark that I mentioned before, to ensure that it doesn't negatively affect your credit. Now, depending on your type of loan, the type of loan you go with, you'll usually want to take out a higher line of credit so that you can actually utilize and keep a balance on there if you absolutely need to, so that it doesn't negatively, affect your utilization portion of your credit score. If this information is helpful to you, please do like, subscribe, and hit the notification bell so that you're reminded to come back on a daily basis and improve in managing your personal finances. Thank you for your time. Enjoy your day, and we'll see you back here tomorrow.